The market keeps hitting new highs, and that's partly because earnings keep not disappointing the market. So the market's providing, the companies are providing the market what it wants, which is steadily growing earnings with no big surprises, no bad M&A decisions that are happening on a big scale. Interest rates, although coming up a bit, are quite muted. So the equity market is still the best game in town. And until profitability starts to falter or interest rates start to come up, which I think are both risks, until that happens, we don't see significant risk to the markets. One specific sector is in the bank sector. Companies like Citigroup, Bank of America, UBS, HSBC, Barclays, these are all banks that have historically got themselves into some level of trouble. But the last couple of years, they've shrunk assets, eliminated or significantly reduced the bad bank portions. Capital's gone from undercapitalized to significantly overcapitalized. And the core businesses, and I'm generalizing across them, the core businesses are generating north of 10% ROEs. Yet they're trading, on average, less than 1 times book value, which doesn't gel with where the businesses are going forward. Yeah, look, there's a lot of reasons why people would be nervous or negative on the banks. They're very highly regulated. They still have some work to do to take costs out of the system to show the underlying profitability of the business. They still have litigation costs. All those reasons are justification to some extent. However, what we don't think the market's fully appreciating is a lot of that work's been done. The core businesses are showing themselves through and actually growing. The barriers to entry are actually quite high. The bad banks or legacy assets have been shrunk significantly, and the capital positions are the best they've ever been. Yet, in many cases, and take Citigroup as an example, which trades at 20-25% below book value, the only reason the difference between book value and the share price can only be seen as a sentiment issue, because there's nothing in that book value or business model that would indicate that's justified. And we think it's just a matter of time till the market catches up to the reality. Our key focus is, can we lose money? Can it go further down? The upside is the secondary consideration. The key metrics on a bank are your quality of loans, your funding, and your capital. And if you perform well on those regards, you're going to be well supported. So in quality of loans, substantially all the mega banks have cleaned up their balance sheets, and the loans they've written in the last several years are actually very well performing loans. The funding is well supported. Loans to deposits are actually in a very good position. In fact, deposits are far in excess of loans, so we don't see no issues there. Capital's gone from, take Citigroup, for example, in the 7% range of tier 1 to about 11. So there's no reason that we see outside of a significant macro global economic downturn, which we're not anticipating, that would cause any of those metrics to get worse, and hence we see the upside support to their share prices from where they are now just getting better. The biggest issue on Australian banks from an investment point of view, I think, is the valuation. You look at Citigroup or Barclays, which is of greater extreme, or HSBC, which is has less issues, but they're traded somewhere between 0.6 times book value and 1.1 times. The Australian banks trade significantly higher than that. Yet they trade that in an environment where their bad debts are very low. So the upside for earnings for Australian banks in a mature economy with very low bad debts already, I think, is quite low. Yet any of those things in terms of bad debts which would impact profitability, I think that valuation risk is quite significant potentially in Australia. The shale revolution has been quite significant. It's basically reversed a 20-year reduction in US production, and so much so that it's about 4 million on a 95 million global base. That's the increase in production. So it has been quite significant. However, we are quite concerned that that production growth has occurred requiring tremendous amount of capital expenditure, and the production itself has the initial decline rates of 60-70% a year. So we see that as quite a challenging business proposition from a cash flow point of view. We like those companies that are able to take advantage of the structurally well-supported oil price, which is approximately $100 a barrel, and can produce it far lower. But they need to have low decline assets, large amount of inventory, and management that are very well aligned to shareholders, not just production growth. Companies like Occidental Petroleum, Denbury Resources fit that mold. I think you have to be careful not to extrapolate the past. The strong performance of equity markets relative to the underlying growth of the global economy has been significantly disproportionate. Now, over time, those things tend to equalize, and I suspect in the years to come it will be a lot harder, and you have to be quite careful to look at, when you look at valuations, you've got to normalize margins. When you look at margins, you've got to see where they've actually benefited from, if it's been weakness in labour markets. So if labour markets are getting stronger and GDP is getting stronger, that could actually be quite negative for corporate profitabilities and PEs. So I think you have to be quite careful not to look at the past and extrapolate, but actually look at the facts on the ground.